The first message here is that Basel III has been accomplished, but it's not the EBF who says it. It is even the Basel Committee who has acknowledged that this monitoring report of the Basel Committee that tracks the progress made in the implementation of the Basel III package that was agreed by the governors and heads of supervision in 2010 has now been accomplished. And literally, in this monitoring report, the latest one from the Basel Committee, it is said all large internationally active banks have met the core equity tier 1 target capital requirements that is available. Unfortunately, I think we have a problem of communication because this is written in the page number 17 of a report that only few people read. But this should be said clear and loud. It is sometimes a pity that after having completed such a long marathon, this is a marathon to complete the more than 500 billion capital raised by European banks in 5 years. After that, at least we should have some recognition, and we should sell to the market that banks are much safer today, because that is a big reality, and it hasn't been without sacrifice. So that is the first message to deliver. Before we start talking about the finalisation of Basel III, it has already been accomplished. Let me be precise. In terms of capital, we know that there are some details in liquidity and SFR, also leverage. That is peanuts compared to the quantity and quality of capital that was the first objective of Basel III is now accomplished. So there is a question here about evaluating the impact of Basel III. As I mentioned before, we ran the first impact of Basel III at the European Banking Federation in 2010. Those days we estimated that European banks, according to the proposals of the Basel Committee, would need to raise more than 500 billion euro. 2 years later, the European Banking Authority came up with official figures, and they confirmed that range of capital. So we are proud and we were lucky with the figure, because talking about figures, it's very difficult to forecast. But we had a rough estimate that finally was confirmed by the official sector, and that is important because nobody better than banks know how much capital is needed to run our business according to the rules that the Basel Committee or whoever proposed. This is also a point that we need to have in mind. But more importantly than the figures, back in 2010 we made 5 recommendations, and 4 of them were taken on board. Fortunately, the phasing period, certain measures regarding the liquidity ratios, also the minority interests that are very much in the interest of European banks. And only 1 recommendation was not taken, unfortunately, to avoid restrictions on dividends. And you know what happened this year in January, because banks were not free. Well-capitalized and healthy banks were not free to distribute coupons. So, but come back to the present. We've mentioned that Basel III has been accomplished. These are the figures from this monitoring report for European banks published by the European Banking Authority. We have on the right side column, as of December 2015, a core equity tier 1 capital of 12.7% on a fully loaded basis. The capital shortfall that was, we can see here, was 544 billion in 2011, is now a mere 5 billion. It's almost next to nothing. The leverage ratio has improved from 2.8, that was, I mean, it is for a very good reason that we are reviewing the regulation. 2.8 on average was probably very low. So now it is almost at the level of 5% on average in Europe, what is the leverage ratio that makes us much more comfortable. And in terms of liquidity, also the degree of compliance is very high compared to the standard that was established by Basel in that package of 2010. So that is maybe the reason why, consciously, the G20 delivered a mandate to the Basel Committee not to increase significantly the capital requirements with the refinements to the standards that they currently underway. However, we face a problem. The market has to offer the capital that banks need to comply with the standards, and the market speaks differently. If we review the market analysis published by many investors, if we review the consultancy documents, the studies by the industry and others, the conclusion of all of them is that the impact would be quite significant. With a wide range, but roughly, we don't have to be precise. The question of whether the impact of the current proposals would be significant has a clear answer. Yes, it would be significant. We don't need to enter into the precision of numbers. Those need to be reviewed. And we know from the Basel Committee these days that they are reviewing the proposals. So we need to be also respectful, because we are hopeful and even confident that the Basel Committee will get it right. They have already acknowledged that the original proposals needed to be reviewed, and they are now, this is a work underway. So let's leave it there. The impact of the original proposals would be quite significant. Okay, turn the page, focus on the revision to those proposals currently underway, and try to make them acceptable and workable when they are finally published at the end of the year. So, if there is no question about this, as a matter of introduction, where did you come from? We can now review the situation of with some flashes about the situation of the European banking sector. I would like to draw your attention to the capitalization in terms of regulatory standards of the European banking sector. We compare it, it's not us, but this graph and this data has been borrowed from Algebris Investments, Morgan Stanley Research and Company Reports. And it portrays the capital ratio in terms of core equity tier 1 from 2010, right before, after the crisis, to 2016 with an estimate. We have in dark blue, that is the bar of the capital ratio of European banks. In light blue, the American banks. We compare Europe with America simply because these are jurisdictions more or less of the same size in terms of banking. We love America. I love America. But we need to have a benchmark. And obviously we compete with our peers who are American banks. And we want to be compared with them, obviously. So what has happened in Europe during the last 6 years is the following. Look at the growth in terms of core equity tier 1 ratio. Those are facts. However, when we read the news, it appears that there's something wrong with European banks in terms of capitalization, that something is incomplete. Of course, you can always have more capital, but that has a cost. We need, again, I repeat, I insist, it has also been mentioned by the chairman of the EIF in his introduction, that communication matters. Communication is very important. And we need to say, first and foremost, that the European banks have increased the capital ratio from 4% to more than 12% in these 6 years. And that makes the safety of the European sector completely different. Of course, the Americans have also increased their capital ratio. They started at a higher point, what is true, but the Europeans have been more ambitious and have passed the American banks in terms of core equity tier 1 capitalization today. Another flash about the return on equity of banks and the cost of equity. What is behind the weak state of the European banks these days is reflected in the gap between the cost of equity and the return on equity. In a healthy banking business, obviously, there should be a positive gap with the return on equity being able to pay for the cost of equity. It is not the case. If it were for 2 years, we can absorb that. But it's been now 6 or 7 years where banks are not able to pay the cost of the equity they need to operate. And that is really quite concerning. The gap is reflected there. The question here is that from 2009, after the crisis, there is a turning point. And we remember when the original discussions after the crisis about the reform of the regulation and the global standards brought up the idea that was very interesting conceptually and from an academic point of view, that if you raise the capital of banks, the cost of that capital should be lower. There is even a theorem of Modigliani and Miller that sustains that raising the capital produces a reduction in the cost of that capital that compensates for the cost of having more capital. That is a theory. Theories don't have to work in practice necessarily. But what we can say today, with hindsight, is that it doesn't work at all for the European banking sector. Because now we have more than double the capital we had in 2010, and the cost of equity remains the same. So there is a very simple equation here. We don't need to run econometric models. If we have more or less the same volume of business in Europe, and we have more than double of capital, and the cost of equity remains the same, it is obvious that the return on equity has halved. And there we are. We are with a return on equity that is barely 4 or 5%. And that is not enough. Why? Because the energy sector and the transportation sector and the pharma sector deliver 10, 11, 9, 12. So that is the problem that the European banking sector is facing today. And we need a solution for that. Obviously, there is a need to strike a balance between regulation, the amount of capital the bank needs to operate, and what they can deliver to the market to raise more capital on a sustainable basis. We can also look at the situation of banks from the accounting point of view. This has been used many times to see whether the market feels that the prospects of the sector are encouraging or not. And the market is, market perception is improving now, but we are still under the book value of our banks. That also gives a message that something needs to be done if we want to come back to a situation where the price of banks in the market is more or less equal to the book value, equal to standard. We also compare here with our peer group of United States, where clearly they also suffer in the crisis a reduction in the value in the market, but they have been able to improve that even beyond, above the book value of their banks. So it's a positive sign. We need to learn from the American banks. They must be doing something better than European banks, or the landscape might be different. The thing is that they have been more able to recover after the crisis. And the market has more confidence. That is the message we're looking at here. So we have seen the return on equity, the cost of equity, the book value of banks, the market value, and the ratio of capital. So where all that take us is the importance and the weight of banks, of European banks across the world. If we combine all those measures that are indicators of where the European banking sector stands, we find that before the crisis, the importance of the European banking sector, and let me say here that we at the European Banking Federation represent more than 4,500 banks, some of them small, medium-sized, big banks, but when it comes to assess the weight and the importance of the European banking sector, especially in cross-border business, we have to look at the big numbers, and those are the big banks that really put the level of the banking sector in a jurisdiction. Before the crisis, 15 out of the 30 largest banks in market capitalization were European. Now we have only 1, 2, 3, 4, 5, 6, and they have lost positions in that ranking. This is something to reflect. I mean, we don't want to make a link, but if we put together all that is happening around, we see that there is something. So the question was raised, will these proposals have a significant impact or not? But before assessing the impact, we need to have a clear view what is Basel III and what is not Basel III. And this is not that obvious. I've been speaking with so many people in the industry, in central banks, Basel Committee, wherever, and not all of them agreed what was Basel III and what wasn't Basel III. In our view, there is a very clear-cut definition of Basel III. It is simply the package that was agreed and approved by the group of governors and heads of supervision in 2010, with a slight amendment in 2011. It is available in the internet, and it had 4 chapters. Improving capital in quality and quantity, that, as we have seen, has already been completed. Risk coverage, that embraces market risk and fundamental regulatory trading book. We are still walking that road, as you know. There are proposals now in Brussels that the Commission will launch towards the end of the year. The implementation of the leverage ratio and the new liquidity ratios. That is Basel III. So anything that is not contemplated in that package cannot be named Basel III. And that is the revision to the standardized approach for credit risk, the constraints and potential removal of internal models, some internal models, the floors based on the standardized approach that is completely new and very controversial because it could hide much of the impact we were talking about, and the revision to the operational risk framework that is also on the way. All that is new. And don't forget that we also have in the offing new standards that have been agreed and accepted by the industry to increase the loss absorbency of capital, TLAC, in Europe also in REL, TLAC in 2 waves to 2019 and 2022. And also we are looking at the potential impact of the revision of IFRS in the expected loss model. Maybe there is no impact, but we still have to be vigilant that there will be an agreement not to increase the prudential requirements as a result of a change in the accounting regulation. That is roughly the landscape of measures that could at some point increase the capital requirements or the conditions for banks to operate in terms of regulation. So having seen that, this looks like a complicated graphic with so many lines because we're talking about internal models. What is behind all the discussion in Basel? I think this is a very important slide. What is behind of this review is to change the rules to calculate the risk-weighted assets. So we have the capital ratio, is the amount of capital that a bank has over the risk-weighted assets. We have been working on improving the numerator until now. The capital has increased more than 2.5 times in Europe. That is only the numerator. It has increased in quantity and also in quality because it has to meet stricter conditions. But we haven't touched the denominator. Why should we touch the denominator? Now, what the Basel Committee is proposing is to touch the denominator, but only or mainly for those who use internal models. So what is the trick of this? It's the following. These are the current Basel rules. Consider that this blue bar is the assets of the European banking sector. 35 trillion, whatever it is the whole balance sheet and assets of the European banking sector. From a regulatory point of view, those assets give risk-weighted assets in an amount that is 37% the volume of assets. Therefore, the famous credit risk weight on average in Europe is about 37%. This is not totally precise. It will be 38, 36, but take 37. So when we translate those assets into the risk involved, we happen to have 37% the volume of assets in terms of risk-weighted assets, and that is what comes to the denominator of the capital ratio. Okay, that's clear. So what the new Basel proposals put forward now is to increase the risk weight at the end. So we would pass, and these are very rough numbers, from 37% to whatever, 50, or a significant increase, not in the capital required, but in the risk weight of the same assets. So as a result of the change in the rules, we have a reduced capital ratio. That is what is at the end at stake in this revision. And that is important, because if we want to keep the same level of capitalization in regulatory terms that we have achieved, and that has taken so long to get there, about 12%, 12.7%, then we can only reduce assets to keep that new 50, 52, or whatever it is, the new risk weight. That is the change we have in front of us. It's not about raising more capital. That was the past. Now it is about touching the denominator and the rules that apply in the calculation of the weight, the risk weight of those same assets. And this is important to know because it has a practical consequence. Technically, some could argue that it is the same, but it's not the same at all, because if I am the CFO of a bank and I am raising capital, as I have done from 2010 to now, I can proudly tell my investors that I have double capital than what I had in 2010. So I can convey a message of confidence. My bank is safer. But it's as a result of a change in the rules of the calculation. My capital ratio is reduced. What can I tell my investor? That the calculations of the Basel Committee were wrong in 2007, and now they've come up with a new way of calculating, and it happens to be X% higher. That is important also in practical terms, right? If anything, if I were the CFO of a bank, I would prefer to raise more capital and leave the rules unchanged, because at least I could tell my investor, okay, I have 20% of capital instead of 12. That would be more beneficial in terms of communication. So that is the trick behind what is being discussed in Basel now. It's not only the capital, but how you can communicate about that. Right. And in order to interpret this risk weight, we have opened a new section about the calculation of this inner factor that is called the risk weight, that nobody talked about some years ago, but now it's becoming a topic.